So I welcome all attendees to this Power Trading with RSI program, and a small brief about myself. My name is Bharat Jhunjhunwala, and I am a CMT master, and I have been trading in the Indian markets from last 10 to 12 years, maybe from early 2006. So I am quite lucky to see two bull phases and two bear phases, and currently we are again moving into a bull phase. I've been using RSI since last 6 years when I came in contact with Andrew Cardwell, and he taught me how to use this tool in a very different way. And I have since then I have working with them in his private client group, and I have been managing some HNI money with the tool. I use RSI as a standalone indicator to trade the markets with price action, of course. And what we're going to see today is today and throughout the whole session, that how you can also use the RSI as a standalone indicator. It means you will not need any other indicator with RSI to trade. It is a self-sufficient indicator in itself. About the questions, please keep your questions with you yourself. We will address the question after the session is over, or maybe in between when we'll take a 15-minute break. I'll go through the questions and I'll answer them. You would just type your questions in the chat box and I'll try to answer them all. And so today is the first session, and we have all attendees in. So let's begin. So your journey begins now. The very first thing when we are trading in the stock market is we have to think in probabilities. It's not like that you have the RSI or you have any other tool and you are 100% sure of what is gonna happen in market. One thing you have to keep in your mind, that the market is driving the RSI or any other tool for that sake. The tool or the indicator is not driving the markets, right? So there is no holy grail or Bhagavad Gita in which you can get the full star of the market. It's not like that. You have to think in probabilities. You have a tool that has been back tested, and tools also fail, right? So if you have a tool, we should make sure that we are more often correct than being wrong. So we have to always think in probabilities. There is nothing 100% in the market. Market is the boss and it is only always correct. So this is a feature of an untrained trader. You have your goal, you have your tool, but you don't know where to shoot, right? And your all trades go here and there. And after you get trained, you're like this. You are a learner trader. You have your RSI as your tool, your trades are hitting the bullseye, and you meet your financial goals. Okay. So let's have a walkthrough to the course, what we are going to learn through this course. First, we'll introduce you to indicators and oscillators, and how indicators and oscillators are used for trend identification, used for overbought and oversold conditions in the market, used for tracking divergence and multi-collinearity. Now this is one thing. This multi-collinearity is a feature that you have to know. This is a what to say, is a myth that every every trader is living in. I'll just show you how as we proceed. Then we'll start the RSI with a small dose of mathematics. We'll go through the formula of the RSI and how RSI works. Learning the formula is more important to understand how the tool is working. Then we'll look at the divergence, the type of divergence, and how to trade the long-term divergence and how to trade the short-term divergence, and we'll have the punch signals in it. Then we'll go through the range rules, the bull and bear zones, how to trade in the zones, trading setups. Then we'll talk about the reversals. Then there is a full guideline on trend analysis, how you can analyze the strength of the trend by using RSI. And then we'll discuss as we go through 7 powerful trading setups with RSI. We will discuss 7 or more than that, basically these setups, and these setups will occur in market every now and then. So we have identified 7 to 8 setups in the market, and when you go through these 7 to 8 setups in the market, one or the other setup you're going to get in the market. Just be sure about it. So it is not like that, with one tool, if you are having only one tool and one setup, you will get in. No, with RSI, you are getting 7 to 8 setups in the market, and any one setup will be there in the market now and then. So you will be able to trade maximum time in the market. And there are biases to avoid while trading with RSI. When we get an RSI, when we see the power of RSI, we often get biased, and we think that the RSI is driving the market. There are some biases to avoid while we are trading with RSI, and we'll go through that. So let's begin. First is the introduction to momentum indicators. Now, what are momentum indicators? They measure the rate at which price rises or falls, at which rate the prices are rising and falling. That means they are a derivative of price. They are not the price itself. The price is driving the momentum indicators. Momentum indicators are not driving the price, right? So first, the price will take into action. The first price will change. The first price will be modified. Then only the momentum indicator will be modified. So again, one thing is clear, that momentum indicators, although they are called the leading indicators, yet they are lagging because they take effect only after the price take effect. Now, every momentum indicator seeks to confirm 3 things. It confirms the direction of the trend, whether we are in a uptrend, downtrend, or sideways. It confirms, it discerns whether the market is being overextended. Means is the market is overextended in one direction, it is oversold or overbought. And it helps us to spot misappropriation between the price and momentum. That is the divergence. It so happens that the price is rising in one direction and the speed of the rate of the rise or fall may decrease. So it helps us to spot that misappropriation between the price and momentum. Okay. Now, how momentum indicators help us in confirmation of the trend? Now, Newton's first law of motion is a trend once started tends to remain in a motion in a straight line. It means that once the trend has started, it will be going on in the same line of direction for some time. It is not that the trend changes overnight or in a matter of a day. The trend, when it is uptrend, it will keep on in that direction, then it will rest for some days, maybe it will make a base, and then it will turn. It is not like that uh, on a single day the trend trends. It's not like that. Every trend change need a proper base and a distribution. This is what this thing means. As the market falls, the momentum settles in the oversold territory. As market builds the prices, prices rise, but numerous false signals keep participant unsure. It means as after the market has fallen and it keeps falling and it makes a base, the momentum indicator remains in the oversold territory for some time. And in that oversold territory, it gives many false signals to the user that yes, the market have started to rise or the market have changed its direction. Now this is the phase where the momentum indicator is basing. It's not going below that par, and still the market has been falling, right? As in the first point we have mentioned that trend has once started, it tends to remain in a motion. So as the market falls and it keeps falling, the oscillator or indicator settles itself in the oversold territory, and as the market is falling, it may give a numerous false signal to the participants that the market have trend changed, but it's not sure. We'll look at it, how it happens. The key market prices levels are broken on upside and prices move higher, confirmed by the momentum indicator. Then the previous supports are taken into action, the previous resistance break out, and we get a higher high, and the momentum indicators confirmed that the market has turned, right? So in this way, the momentum indicator and price confirmation both are with us now. We are making higher highs now, and the momentum indicators have turned up. This tells us that the market is increasing. The prices post higher high, but momentum indicators slacken off as prices are not rising with the same speed. Now what happens when the market start rising and it has taken its trend up? The momentum indicator now back offs, and the prices are not rising with the same speed. It means that as today the price have risen 10 points, tomorrow again 8 points, and day after again 6 points. Now the prices are rising every day, 10 points, 8 points and 6 points, but the rate has decreased. It has not been rising with the same speed, and this is indicated in the momentum indicators, that the prices, though the prices are rising, though we are making higher highs, but the rate at which the prices are rising is not the same. So the momentum indicators gives us a pre-signal that the prices are not rising at the same speed, and we should be little bit alert now. Now, overbought and oversold. This is another feature of an indicator, and we always come across this feature, overbought and oversold. When I will go through the RSI, uh, you will see that this overbought and oversold feature is a myth, right? But again, it is a feature that everybody and everyone is using, and so it is should not be ignored. Let us see what overbought means. A market is termed overbought when the prices have been trending higher in a relatively steep fashion for some time, to the extent that a number of market participants holding long positions weighs out those on the sidelines or holding short. This means there are increasingly fewer participants left and to jump back on the trend, right? Now what has happened, a market is termed overbought when the number of sellers, the number of buyers increase and out increase the people who are selling or the people who are sideways. That means everybody is buying and nobody is there to sell, and many people are also sitting on the sides to buy. So this happens when the prices become overbought and the momentum indicator moves into the overbought zone. Here is the chart when we'll see that the RSI has become overbought. Here you can look at here and you can see here that no other buyer is present in the market. As a result, the market falls again. That means no buyer is present in the market anymore, and as a result the market falls again. Again at this point we see the market becomes overbought, no other buyers are remaining, and the market falls again. This time it falls again steeply. Same thing happens here, absence of buyers, nobody is buying, and the market falls again steeply. So these are the overbought zones, and these overbought zones are set by the indicators, the default values, and when the indicator reaches these overbought zones, we should be alert that the market is going to correct. Now oversold zones, it's just the opposite of overbought zones. It's A market is termed oversold when the prices have been trending lower in a relatively steep fashion for some time, to the extent that the number of market participants holding short positions significantly outweighs those on the sidelines or holding long positions. This means there are increasingly fewer participants left to jump onto back downtrend. That means that everybody is selling in the market. What is oversold? Oversold is means everybody is selling. Just keep this in mind. And there are no participants to buy, and there are no participants to get into more selling, and the sellers have taken over the long positions and also the people who are sitting on the sidelines. So the market goes into the oversold zone. Oversold basically means everybody is selling. So this is a different thing with if you have learned from anywhere else that oversold, people say when the market get oversold we have to buy, and it's just the opposite. When the market get oversold, that means everybody is selling. We have to look for opportunity to choose to sell in the market, and how we'll discuss when we'll do the RSI. So here we see the oversold zones. If the market is oversold, if the market is oversold, nobody is left to sell anything, and as in reaction, you see highs up. That means nobody is left to sell anything. All selling have taken place. There are no fresh sellers. Even the buyers have been outweighed by the sellers. So there's a question: overbought and oversold does predict a turn. The mere fact that a momentum indicator is overbought or oversold territory is not itself a signal to exit the trend following trade. That means when you see the indicators have crept into an oversold territory or an overbought territory, it does not give you a signal to exit the trade. That means if you were holding a long trade and suddenly RSI moves into the 70 zone, that is the oversold zone, that does not signals you to exit your long trades. It may so happen that the RSI may remain above 70 for many months or many days, right? So it is not a signal for you to exit your trade once the RSI moves into the overbought zone. The mathematical calculation or construction of the indicator is such that in strong trends, the indicator remains in the extended zones for some time. It so happens that the indicators are mathematically constructed, and their formula or the construction makes them to stay in the overbought zones when even the trend is trending higher. Right? We are getting higher highs, the trend is strong, and the indicator will stay in the overbought zone for some time. It is the mathematical formula that leads to that. It is not that once the indicator have moved into the overbought zone or your oversold zone, then you have to exit your position. No, it's not like that. So see here, the market, here the price become oversold, and as a trend following, if you are a trend follower, this is the place where you must have taken a position, as there is an head and shoulder, something like that, and the RSI moves into an oversold zone. Now when you look at this, you will think that the RSI has moved into the oversold zone and you should cut your positions. It's not like that. See what happens after that. Oversold zone, a small blip up on upside, and then again the trend continues down. Again the RSI comes into the oversold zone at this place. Now if you have exited your positions at this place thinking it is an oversold, so you must have missed this part. Again here the RSI creeps into the oversold zone, and again we move down. So basically, if you can say that oversold means more people are selling, right? And similarly in the overbought zone, here the RSI touches 70 again, you will think that the RSI has gone into the overbought zone. We should exit our position. After that, there is a small blip and a new high is made. Again, the RSI touches the overbought zone. Again, a blip and again a new high is made. So, it's a clear indication that oversold and overbought zone are just an extension of the current trend. It's not like that when you get into an oversold zone, you have to sell or something like that. Right? You have to hold your position, then you have to watch the price action to take any action. This is the next slide. This is the ACC chart, and same thing we see. The prices hit the overbought, oversold zone at this level, and a new low is made. Similarly, prices again hits the oversold zone, and again a new low is made. Again oversold zone and a new low, and again an oversold zone and a new low. So if you are in a position and you have shorted this stock, and somehow with this candlestick pattern or something like that, any of your trend following system must have given you signal to short this stock, and suddenly the stock moves into the oversold zone and you exit your position. And if you have exited a position and at this point seeing that this is the oversold zone, RSI has crept into the oversold zone, must have exit my position, then you must have missed the whole move downside. Again similarly here, and this was the biggest move. Next slide. See, this is Adani Enterprise, and the prices moved into the overbought zone here and then moved higher. Again it moved into the overbought zone here, and again the price moved higher. Overbought zone, higher high. Overbought zone, higher high. Overbought, higher high. Overbought, higher high. Right. So this is the way basically overbought and oversold zone are made, because it's due to the mathematical construction of the formula that once the RSI or any indicator moves up, the indicator will go into the overbought zone and it tends to stay there for some time, because it's the mathematical construction of the formula, right? So now we'll talk about divergence. Just a moment. Now this is the most popular thing with indicators when we talk about divergence. Everybody, and on social media, in the news channel events, the people have started talking about divergence. And uh, what now let's go through what divergence are. Bearish divergence is described as a situation in which the market continues to trend up but the momentum indicator is heading down. That means the market is moving up, the market is moving higher high, making higher high, the prices are making higher high, and the momentum indicator slackens off and makes a lower high. What that means? That the rate at which the prices were moving before has decreased. So there is a bearish divergence. And in the same way, bullish divergence describes a situation in which the market continues to trend down but the momentum indicator is heading up. This means that the market is falling and the momentum indicator is rising. Market is making a lower low and the momentum indicator is making the higher low. Now just see, this is the price and the price is moving higher and it is making a higher high. That means the price is moving in uptrends, and here the indicator was following the price, and suddenly at this point when the price makes an higher high, the indicator makes an higher low. So this is a bearish divergence. That means it is indicating that the rate at which the market was moving previously is not, now it's not moving like that. So the prices are making higher high and the indicators make a higher low. This is the bearish divergence because we are in the bull phase and suddenly the indicator slackens and gives us a bearish signal, that is the rate at which the market was moving higher is lessening now. And this is the bullish divergence. That means the prices are making lower low. The indicator followed the price and suddenly the indicator does not make a lower low, it makes a lower high. So it does not follow the price. There is a divergence between the price and the indicator. So this is the bullish divergence, as the indicator is indicating a bullish scenario, whereas the price is indicating a bearish scenario. Now, one thing everyone should have noticed, that when we were talking about the bullish divergence or bearish divergence, the bullish divergence has appeared when the price have made lower lows. When the price is making lower lows, that means we are moving into a bear market. When the price makes lower lows, that means it is a bear market. And the divergence in the indicator makes a bullish divergence. That means one thing you can infer, that a bullish divergence appears in a bearish market, right? So this price have made a lower low, that means we are moving into a bear phase, and suddenly in this bear market this divergence appears. That means the bullish divergence appears in a bear phase, and similarly the bearish divergence appear in a bull phase when the market is rising. Keep a note of this because this is a very important funda, and we'll look uh, in coming days how we can use it into our trading. So here we get the price making an higher high. This is Oro Pharma, and the indicator make a lower high. And when we see this reaction, next Axis Bank, again the price makes an higher high, the indicators make a higher low, and then we see this reaction. This is a bearish divergence in the bull market. The prices are recording higher highs and suddenly the indicators record a lower high, and then we get a reaction. Bank of Baroda, the prices are making lower low, and we have a bullish divergence. The price have made a lower low, the indicators make a lower high, we see a bullish divergence. So this is the bear market. The price is making a lower low and suddenly a bullish divergence appears. So the bullish divergence appears in a bear market. Similarly, this thing, we have a bear market, price makes a lower low and the indicators make a higher low, and then we get a reaction on the upside. This is a bear market where we make lower low and the indicators make a higher low, a reaction that we get. So divergence tells us although that the trend is still intact as evidenced by the move to a new high or low, the speed of the rise or the fall is lessening. This is what I told just a moment before, because uh, when the divergence is occurring, the price has still made an higher high or a lower low. When we are in a bull trend, the prices are recording high highs. Though the divergence occurs, but still the prices have recorded higher high. That means still we are in a bull market phase as the prices are recording higher high. As the prices are always the king. In the beginning, I told you it is the price that drives the RSI, or it is the price which drives the momentum indicator, not the momentum indicator is driving the price. So when we are making a lower low, the indicator is making an higher low, and we are still in a bearish phase when we are making a lower low. The price action still tell us that we are in a bearish phase when we are making a lower low, although the indicator has made an higher low. So divergence frequently precedes a turn as some sort of top or base building. It is best to look for confirming patterns forming on our price chart as well as momentum divergence in indicator. This is a good warning sign for raising our protective stops, as it may be a precursor to market turn. Now what happens when we get a divergence, for say prices are making a lower low in a bearish market and we get a bullish divergence, we should look at our price chart for any price pattern or any reversal pattern. Are we getting any reversal pattern? It can so happen that when the price makes an lower low and the indicators make an lower high, there may be a double bottom formation in the bear market, or there may be an inverse head and shoulder, or there may be a triangle, building up. So we have to look at our chart, price chart, as well as momentum divergence. If the momentum divergence is confirmed by a price chart, right? Suppose we are making a double bottom, W pattern, and the indicator is showing us a turn. It has made a lower high. So it may give us a little bit confidence. Yes, the market may turn, and this divergence may be the true divergence. So we have to always refer to our price action. Now see, in this example, as I mentioned, the price action is more important than the indicator. I have been, from the very first slide, I have been putting emphasis on this only, that the indicator is not the driving force that drives the price. See, the Asian Paint has made an higher high in this slide, and the RSI made a lower high. That means in the bull trend, the RSI made an divergence, but the market does not pay heed to this divergence and move higher. Similarly, at this place also, at this juncture also, the price makes a higher high and the indicator makes a lower high. There is a divergence, there is a bullish divergence. Again, the market is paying no heed to this bullish divergence and moves high. This is SCL Tech. Again, the same thing. It's in the bullish phase. The prices are recording higher highs. The indicator records a lower high, but the prices continue upwards. It won't correct. So this is what I was telling, that this bearish divergence will occur in a bullish market always, and vice versa. So this is DLF. The prices make a lower low, that is, it is in a bearish trend. There is a bullish divergence. Still we see no signal, no pattern in the price chart, and prices again records a new lower low, though the momentum indicator is showing a bullish divergence. So here, from here, what we can infer that in bear market we will always see a bullish divergence. This is a very important concept that will help you moving forward. This TB, again we see lower lows and a bullish divergence. The market pays no heed to this bullish divergence because the market is the king and it is driving the price, not the RSI. Falls again. Again, it makes a lower low. The RSI makes a higher low. A bullish divergence is recorded. The market pays no heed and falls down. So the divergence is just an overextension, or just an, you know, type of mathematical constant is there that makes the prices diverge in a. So we can also, with this we can infer that when we are in a bull market we will see bearish divergence, and when we are in a bear market we will see bullish divergence. This is the main thing which I want to put emphasis on this one. Now, the popular indicator and oscillators. There are many popular indicator and oscillators that you will come through when you buy a software package and you see the indicator list. There's the whole arsenal of indicators there, and you get overwhelmed by seeing this, and you think that you have got many uh, weapons to fight the markets. So from the most popular are stochastics, RSI, commodity channel index, that you will often, these are the indicators that you will often come across in many social media or anywhere. William percentage R, TRIX, ultimate oscillator, the Rune oscillator, and the rate of change. Now, learning all these indicators, or going through all these indicators, or following all these indicators is of any help. What it tells us, if on your chart you have put the stochastics, on your chart if you put the RSI, the CCI, the Williams R, the TRIX, the ultimate oscillator, Rune ROC, are you getting some extra confirmation, or are you getting some extra information from the market when you're using so many indicators? Let's see. This using so many indicators is called multi-collinearity. Now, multi-collinearity is a statistical term for a problem that is common in technical analysis. That is, one unknowingly uses the same type of information more than once. Analysts need to be, just a moment, please keep yourself on mute, everybody. Okay. Analysts need to be careful and not utilize the indicators that reveal the same type of information. That means when you're using so many indicators at the same time, you are using the stochastics, you're using the RSI, you're using the ROC, you're using the percentage R, you're using the CCI. These are derived from the price using similar concept and similar formula. And it is not that when you're using so many indicators on your price chart, you're getting an extra confirmation. No, it's not like, it's not that. It's not like that. They are telling you the same thing. And when We see so many indicators telling us the same thing. We often tends to get very much diverted that so many indicators are indicating sell. So this is a strong sell. No, this is not a strong sell. This is called a multi-collinear trap. You are getting trapped into the multi-collinearity thing, because they are telling us the same thing. They are not giving you the strength. They're telling you that they are giving you the same information, because they are derived from the same formula, or basically they are derived using the same method or same working. The formula may be different, but what they tell is the same. And an example would be using many indicators that portray momentum, like using RSI, ROC together doesn't make sense, as both are derived from the closing price. See, this is what I was telling you. The RSI, the ROC, the CCI, the percentage Williams R, they are all derived from the closing price. So what they will tell the same thing. If there is a divergence in RSI, if there is divergence in ROC, there is a divergence in Williams percentage R, they are indicating the same thing because they are derived in the similar way. So it is not that you are getting a more stronger signal. It is a trap. It is telling you the same thing, same information in a different way, but it tells you the same thing. So instead of using RSI and stochastics will make more sense, as stochastic will include a range into analysis. Similarly, MACD can also be employed for a trend. Now what this means, that if you want to use multiple indicators, we should use indicators that are derived in a different manner. Suppose RSI is derived from the closing price of an price chart. Stochastic is derived from the range, that is from the high and the low. The calculation is done taking the range into the account, the high and the low. RSI is derived from the price. MACD is a trend following indicator, that is, it is derived from the moving average. So the derivation of these three indicators are different. So if you want to mingle up or mix up your analysis, we should use indicators that are derived in a different manner. So if you're using the RSI, you're using the Williams percentage R, or you're using the ROC, these three are derived from the closing price itself. So it is not going to tell you something different. It will tell you all the same thing. And if you are using RSI and stochastics, now RSI is derived from the closing price and stochastic is derived from the high-low range. So these are using different things, different factor for the calculation. Whereas the RSI using the closing price, stochastic use the high-low price. The factors are different. So these two indicators will tell you the different thing. And when you will get confirmation from these two indicators, this you can tell us is a double confirmation. And similarly, MACD is derived from a moving average. So if we can use these three indicators in tandem, then it will make some sense. Now in this chart, if you can see this chart, I have put the RSI, I have put the CCI, I have put the ultimate indicator, and I have put the Williams percentage R with all the different values. And between these two vertical lines, you can see the RSI has moved into the oversold zone, the CCI moved into the oversold zone, the ultimate indicator moves into the oversold zone, and the Williams percentage R moves into the oversold zone. So these four indicators are derived from the closing price, and they are telling us the same thing, that the price at this level has become overbought, sorry. They're not telling, these four are telling us the same thing. It is not telling that, it is not like that RSI is telling us the price has become overbought, CCI is telling us the price has become overbought, ultimate indicator is telling us the price has become overbought, and Williams. So you get four confirmation from four indicators and you're going to short. No, it's not like that. They are giving us the same information. Similarly, if you can see this within the box, you will see that the RSI has become oversold, the CCI has become oversold, the ultimate indicator has become oversold, and similarly this Williams percentage R has become oversold. So at this price level, all the four indicators have become oversold. But this does not give you the power of four. No, these four indicators are telling you the same thing, that the prices have become oversold at this level because the derivation and calculation is almost the same. So you're not getting extra confirmation or four times confirmation on the thing that the price have become oversold here. No, it's not like that. It tells us the same thing. So this is the biggest mistake that many analysts are doing. Whenever I see any charts on everywhere, anywhere, and I see it clipped up with many indicators. People are using the RSI, they are using the CCI, they use their own indicators, and they use many things, whatever they want, and they say that that the indicator has, the market has become oversold, and it has been portrayed by four indicators. It's not like that. They're telling us the same thing. It is the information trauma that we are gathering. We're not making our analysis four times stronger. See, the same thing. In this chart, we see a divergence here, a bearish divergence. The price have made an higher high, and in RSI, we see the price have made a lower high, bearish divergence. CCI, the price have made the lower high. Ultimate, the price have made a lower high. Williams R, the price have made a lower high. So does this mean that we are getting any information four times stronger? No. These four indicators are telling the same thing because they are derived using the closing price. So the formula is different. The information is same. So we are not getting any 4x information. No. We are getting 1x information. We are only getting information, 1x information, right? We're not getting four times four information. So we have to avoid this collinear trap. Only one indicator is sufficient to tell the prices have become overbought or oversold. You don't need to refer to 10 indicators. You don't need to uh, doom yourself with the idea that four indicators are telling that the market have become oversold. So I have to buy. I'm getting four times stronger signal. No, it's not like that. It tells us the same thing. So technical indicators should be arranged in categories to keep them from using same category. Now, what I have done, I have categorized the technical indicator, the different technical indicator into categories. So it will be easy for you when you use them. You make sure that you don't use the same category of indicators. Suppose momentum. Momentum indicator is tell us the rate of change of price, right? RSI, CCI, Williams the stocks RSI, tricks, ultimate oscillator, Arun indicator and stochastics are telling us the same thing. It is telling us the rate of change. These indicators tell the rate of change of the closing price, and this stochastic tell us the range, the high-low rate of change. So if you're using these indicators together on the chart, you're using the same information 4, 5, 6 times. You're not getting different information. You're not getting different uh, confirmation from different dimensions. No, you're getting the same information. Similarly, trend following that utilizes the moving averages in the calculation is MACD, ATR, ADX, DMI, and price oscillators. These indicators tell us the same thing. They are derived from the moving averages and they tell us the same thing. So do not clutter your charts with the same indicators. Volume indicators tell us the accumulation distribution process, and Jacqueline money flow, volume ROC, volume oscillator, demand index, on balance volume, money flow index tell us the same thing about accumulation and distribution. They does not four or five volume indicators together does not tell us that the the accumulation is 4 times more or 4 times less, or the distribution is 4 times more. No, they tell us the same thing. The dimensions are same, the calculations are same. They tell us the same thing, not the different thing. All right. Now, before getting into RSI, uh, is there any questions that I can, address to? If you have any question, you can type in the chat box, and I'll try to answer them. Okay, confusion about divergence. RSI can be checked in any time frame. You can check, you can use it from 1 minute to monthly. Yes, divergence, as we move forward, we'll see how we can trade divergence. As we move forward, there are trading setups using divergence. Right, there are false divergence. That's why I'm telling you, we'll move forward and see how we can trade divergence. We have many setups using divergence, and you will see that uh, the way you have been trading divergence or way you have been looking at divergence is very different. All your myths about divergence will get cleared as we move forward. Don't worry. Don't worry about the divergences. As we do RSI, we'll get into very detailed using divergence, how we can trade divergence. Yes, Sandeep, as we move forward, we will talk more on divergence. When we'll do RSI into detail, we'll talk more about divergence. All your confusion will get cleared there. Whole one session of 2.5 hours we will spend on divergence and how to trade them. Don't worry. This was just an introduction. Sir, as I told you, when we'll move forward, we'll talk about divergence. We'll talk about how to trade divergence. And when I am talking about how to trade divergence, I'll talk about the stop loss and even the targets. No one in this world will tell you that divergence can be traded with a stop loss and a target. And I'll show you how that when we trade with divergence, we have a target and a stop loss. Don't worry about it. One thing I can assure you, after completing the RSI with us, the whole thing, the whole preview, your whole style to look at the market will change. You will not look at the market as you are doing right now. No, sir, I prefer to see charts with my naked eyes. I don't use any codes. There may be many codes available if you can Google it. Shall I move forward? Thank you. So let's begin the RSI. The RSI was developed by J. Wallace Baldo Jr. in late 1970s. This is the great man who have developed the RSI, and he has also developed an arsenal of many tools in his new book. In his book, a New Concept in Technical Trading System, that was published in 1978. If you have a chance, please go through this book. This is a great read. There were many indicators that Mr. Wilder developed as to make trading easy. ADX was one of them. Parabolic SAR was one of them in that book. It's a great read. RSI measures the speed and change of the price movement, the rate of change of the price movement. That is what RSI measures. The RSI oscillates between 0 and 100. That is, it means that it is a banded cyclic indicator, and it oscillates between 0 and 100. That is, it cannot move below 0 and it cannot extend above 100. According to Wells Wilder, when RSI reached 70, the market was overbought, and when it reached below 30, the market is oversold. He believed when the RSI moved into the 70 zone, we move into an overbought area and we need to see a correction as the market is overextended in a zone. And similarly, when it moves below 30, he thought that the market is oversold and again a correction is needed. And how he uses the RSI, he used RSI to look at the divergence that we were looking right now. But this is not the way to look at RSI. Failure swings that fails very often, and center line reversal. We'll discuss these things in detail as we go forward. RSI is an extremely popular indicator, and it is featured in number of articles and interviews and number of books. This is the most popular indicator. Every analyst, technical analyst, have used or must have used the RSI because it gives us one single line and it looks very simple. So RSI is the most popular indicator. Now Andrew Cardwell used this indicator in a very unconventional way and introduced altogether a new set of rules and signals that have enhanced the use of RSI. Now, as Welder-Wiles used the failure swings, the divergence, the overbought and oversold signals, Andrew Cardwell took the indicator with the same settings and he used a whole new set of rules. He was not using what was mentioned in the article of the book by Wilder, but he enhanced the use of indicator by using it in a very different way. He changed the rules altogether, and we'll go through that only in this course. Now a little bit of math. Now, it is very important to know the indicator inside out, what you're using, why RSI, how our RSI is calculated, and why it behaves in a certain manner where when it reaches some levels. So it's more important to know. So RSI is based upon the observation that prices tend to close higher when the trend is rising higher and tend to close lower when the trend is following. That means it is based when the market is moving higher, the prices, the close should be higher, right? That's it means that today the market has closed on 8,000. Tomorrow the market closing at 8,050. Day after it is closing at 8,100. That means as the market is moving higher, the close are also higher than the previous closes, right? So it is utilizing that thing, that when a trend is going on, the closes tends to get higher. The trend is rising, the closes are higher. The trend is falling, the closes are lower than the previous close. If the trend is rising, the closes should be higher from the previous close. And RSI is utilizing the daily closing price only. It is not utilizing the daily range. It does not utilize the high and the low range, the high prices or low prices. It utilizes only the closing price. It is based on the closing price. So it is very simple, and you can even utilize it on a close only chart, on a line chart. That is it based on the closing price only. RSI compares the average rise on the up days with the average fall on the down days. That means if 5 days, if we are using the 14 period RSI, and on the 8 days the RSI rises higher, and on 6 days the RSI falls, that is moves downward. So the formula is such that it compares the rise on the 8 days and the falls on the 6 days. So this is the way the RSI is derived. Excuse me. This comparison is then expressed in a number between 0 and 100. Then by using a formula and standardizing it, we make it a banded indicator, and we use it between 0 and 100. And this high and low is this high and low is the back calculation is 14 days. That means we see high and low of the last 14 period. The standard practice is to use a 14-day time period. Now there is a lot of debate on this thing. Why we use a 14-day period, and we'll see as we move forward. So this is the formula. The RSI is 100 minus 100 by 1 plus RS, and RS is the relative strength, that is average gain, average rise of the up days of last 14 days divided by the average fall of the last 14 days. And we put this RS into this formula, and the RSI for today is derived. So let's move forward. Now let's see overbought and oversold zone with RSI. Now measuring the momentums allow us to estimate when the speed in one direction is overdone. That means as the prices are moving higher and higher, they are moving in the same direction, and it moves into a zone where we can very well derive that the speed in a single direction on this direction is overdone. Overbought and oversold zone are identified on the oscillators, and these are points where prices may hit some price extreme. On the right side you can see the chart is there, and I have marked the oversold and overbought zone. I have marked the oversold zone with red and overbought zone with blue, and we can see that the price is rising. The RSI moves into the overbought zone many times, and it hit the extremes. That means the prices are hitting the extreme, and as the RSI is a banded oscillator, it moves into the zone and comes back again. It cannot keep rising with the price. Overbought and oversold zones are cyclical bound of the indicator. As I told you, same thing. As we know that RSI formula is derived in such a way that it has to oscillate between 0 and 100. So overbought and overzoned are cyclically bound of an indicator. Now we all know that 30 and 70 are the limits of the RSI. Now why has anybody given it a thought that why 70 and 30 becomes the RSI limits? Why? Because Wilder said so. Why you will listen to Wilder? Is he God? No, he's not. What must have made Wilder think that 70 is an overbought and 30 is an oversold? I know. Just I'm giving you a minute to think that what has to happen when RSI moves into a 70 zone, or what has to happen when RSI is moving into a 30 zone. Just give it a thought that what happens when RSI is becoming oversold and what happens when RSI is becoming overbought. Just give it a thought. And you can type in your thoughts in the chat box. What has made RSI moved into 70 zone and what has made RSI move into 30 zone? What would have happened in the market? Anybody? Market has just started a trend. Trend is stronger because of the math. Okay, everyone is quite clear, quite close, not very clear. Now, when RSI moves into a 70 zone, what has happened? 70% of the times the prices have recorded a higher close. That means out of 14 days, 70% of the time, means out of 14 days, 9 days, the prices have recorded higher closes that led RSI to move in the 70 zone. What we derive from that? Out of 14 days, the 9 days the price have been in uptrend. So we moved into an overbought zone when the prices were in uptrend. Similarly, when the RSI moved into the 30 area, what has happened? 9 out of 14 days, the prices have recorded lower closes. That means the prices are in a downtrend. When you are reading an indicator or when you are trading with an indicator, it is very important to know why the limits are set and why it behaves in a certain manner. Any course over the internet, any book will not tell you this. So, a very simple inference that when we move into a 70 zone, we have recorded a higher close. That is, we are in an uptrend. Similarly, when we moved into a 30 zone, that means 9 out of 14 times the price have recorded lower closes. That means we are in a downtrend, and so we are moving into a 30 zone. We are moving in an oversold zone. This has to happen in the market when price moves to extremes, right? So the doors are opening. And why 14 period is the default look back period? It is the lunar phase of 28 periods. We have a lunar phase of 28 period, and half of the lunar phase is 14 days. And Wilder took this 14 days as a default period as the half of the lunar phase. because he thought that the market is very much dependent on the lunar phase, and as the phase changes, the activities of market and the people, their behavior changes with the lunar phase. So he used a 14-day period. So here there's the chart, and I have plotted the 14-day RSI on the upside and the 5-day RSI on the lower side. The 70 and 30 bounds in RSI 14 and 5. You will see that the RSI 5 is more volatile than RSI 70. So which one we use, sir? We use RSI 14 only. The usage of RSI 5 is a very different thing. The overbought and oversold levels are different there. This is just to tell you that what happens when you decrease the time frame of the RSI, you get these volatility and everything becomes blur, compact. You can't understand anything. So keep the RSI period 14 as of now. As we move forward with the course, we will see how we can utilize shorter period RSI and under what conditions. So how do we deal with oversold and overbought zones? So here comes your first trading setup. How you can deal with the overbought and oversold zone. Overbought and oversold zones are areas in an oscillators or zones where the stock trend is temporarily overextended. That means when overbought and oversold zones are reached, the ongoing trend is overextended, means it has extended itself more there. Hence, pullbacks from the zone can be expected before the trend resumes. Pullbacks from the zone. It's not the change in trend. It is a pullback from the zone. That means we get a retracement in the ongoing trend. It's not like that the trend is changing altogether. It's a pullback in the ongoing trend. So during strong trends, a pullback from the overbought and oversold areas will halt near a neutral zone. The neutral zone is the 50 level of the RSI, where the bull and the bear powers are equal. So when we move into an overbought and oversold area, from there we will get a correction, and then we will dive down into the neutral zone, that is near the 50 area, and then we will resume the trend again. So any move from the overbought and oversold area is just a pullback in the ongoing trend. It does not mean the trend has changed. A rise, now this is a good concept, I have marked in red. A rise or a fall failing to take the oscillator reading into the overbought and oversold is a sign of weakness or strong in the trend. That means that when a price rises, it should take the oscillator into the overbought zone, and if it fails to take the oscillator into the overbought zone, this is the sign of weakness for the trend. Suppose here it is the RSI and this is the 70 area and this is the 30 area. So the price have rose here and the RSI has moved above 70. Then the price falls, RSI also falls, and it halts near the neutral zone or maybe more lower, and RSI rises again, price rises again, RSI rises with the price, and this time what happens? This price rise have failed to take the oscillator into the overbought zone again. A rise to take the oscillator reading into the overbought zone is a sign of weakness of that trend. That means that if this price rise has failed to take the oscillator again into the 70 zone, is a sign of weakness for the ongoing trend. Right? Get this? Please understand this very carefully. Similarly, this is 70 and this is 30. The price falls, the price goes to an oversold area, then it falls again, and this thing happens. Now this fall in the price has failed to take the RSI in the oversold zone. That is, this price has not taken the RSI again into the oversold area. This is a sign of weakness for the downtrend, ongoing downtrend. That means the ongoing downtrend may be in danger right now, or may be in some sort of danger, as this push up price has failed to take the oscillator again into the oversold zone. That means the rate at which the price were falling here in this area is not similar. This rate have decreased here. Right? A new push into the overbought or oversold is sign of strength and the next dip and the rise to be bought. So this is our one of the setups that I'll just show you on chart. That means this is 70 and this is 30. Sorry for the drawing. And when the price is rising, the indicator rises and takes the RSI into the oversold zone, that overbought zone, that is above 70. Now price retraces, as it is mentioned that price will retrace from the extended zone. So as the price start moving up from here,
बंद करूं तो वही तो देखूं.
please everybody keep yourself on mute, maybe disturbing. So where I was, so it disturbs. Yeah, as the price moves higher, the RSI is moved into an oversold zone, overbought zone, sorry. This is a sign of strength. The next correction in price, this correction has to be bought. And if it takes you into the oversold zone again, that means you have bought a strong trend here. Am I making myself clear? Right? This is one of the first setups that we have learned. Okay, I am explaining it once more. This is 70, that is the oversold zone, overbought zone for the RSI, overbought zone for the RSI, and this is 30, that is the oversold zone for the RSI. And here I am drawing the prices. As the price move up, the RSI moves up. and the price is so strong that it pushes the RSI into the overbought area. Now the prices are moving down and the RSI moves down. Now this first dip in price can be bought. As the prices will move again, when the prices start moving from here, rolling up again, this first dip can be bought. This price will move up again and the RSI will move up again. It will again go into the overbought zone. So you have bought into strength. Right? Similarly, we have to do in the downtrend. We'll see some charts right now with this example. So this was our setup number 1. What we are doing in it? We are buying the strength and we are selling the weakness. When RSI is moving through the overbought zone, that means the RSI have raised 9 days out of 14 days. So we are buying the strength, right? And similarly, when the RSI falls below 30 and moves up again, that means 9 out of 14 days the RSI have recorded lower close prices and we are selling the weakness. Yes, the time frame does not matter, sir. RSI is a fractal indicator. You can use this from 1 minute to monthly if your patience allow you. So here we get it. See, the first push at point A, the RSI get pushed in the overbought zone. Then the prices correct. The RSI also corrects. And we'll look at some candle patterns or maybe of the Fibonacci retracement here. We'll look at for the support and we'll buy as the RSI or as the price turns. We'll buy here, and once we buy, the low of this thing will be the stop loss, and we'll wait, and again the RSI moves into the overbought zone at point B. Again there is a reaction downwards. It moves out from the overbought zone. Here again we see the price action. We see the long tails, we see the candles. We buy again, and again it moves up to point C and moves into an overbought zone. Similarly at point C, after moving out of point C, it corrects again. RSI moves into the from the overbought zone to the neutral zone. We see a bullish candle here. We buy it, and again the RSI moves into an overbought zone. Again there is a dip. We buy here with the bullish candle. RSI moves up again. The price moves up again, and this time what happens? The RSI has failed to move into the overbought zone. It's a failure. And here, once we see that it is a failure, we exit. It indicates weakness in the trend, no more strength. And suddenly the prices start falling. Weak momentum lead to the correction. That means the RSI, the prices are no more closing near their highs now at these levels. The momentum has failed to sustain. All right, simple, isn't it? Life has become so simple suddenly with the trading. Is it clear? I can promise you, this way no one will have ever explained you or may have helped you to trade overbought and oversold zone. Nowhere you can find this. किसी book में नहीं है. It's all in my mind and in Andrew sir's mind, of course. Let's move to the next slide. So here the RSI moves up and pushes the price into an overbought zone. RSI moves down, the prices move down, prices start turning, RSI start turning, prices make a higher close, RSI fails to go to the overbought zone. You exit your position here when you see that the RSI has failed to go to the overbought zone. And you save yourself from this thing. I will not recommend shorting it here. Not as of now with these tools. Of course, we have tools and we have setups in RSI which with which we can short it here also, but not with this funda, but not with this setup. I'll not recommend it to short it here. Then the RSI, the prices move down. The RSI moves to the oversold zone here at X. The prices are moving down. The prices move up, make a swing high and moves down again. Here the RSI fails to go to the overbought zone, oversold zone at 30 at this level. Right? You have an hammer. You have a gap. You buy it here at this point. As RSI moves to the oversold area, overbought area, moves out from the oversold area and moves to the overbought area here. This means that this fall has become weak as our RSI has failed to move into the oversold zone again. If you are an aggressive trader, you could easily buy here. So you catch the lows almost. right? If you are a conservative trader, to buy you wait for this level to be crossed. This is a sign of strength for the bulls, and it's a sign of weakness for the ongoing trend, that is the downtrend. Then RSI moves above 70, prices correct. Then again it moves above 70, prices correct. Take positions at every fall, and again this move. What a move! This move again it moves to the overbought zone. You take your trade, again it falls down here, and this time it fails to move to the overbought zone here. You exit. As simple as that. It can't be more simple than this thing. Alright. Hope everybody is getting what I am telling. Now for the sell setup. Similarly, after this fall, the RSI goes to the oversold zone. Prices moves up, RSI moves up, and again falls to the oversold zone. Take your sell here. Again prices move up, RSI moves up, but the RSI does not carry to the overbought area. That means the trend is still intact in the downside, because the prices have carried to the oversold area and it has not carried to the overbought area. This means the ongoing trend is still intact. Fall again. It touches the oversold area again. The rise again not able to reach to the 70. You take your sell here again by whatever method you are using. Moving average, Fibonacci, candlesticks, anything. Again it moves down. Touches the oversold area. Moves up again. There you go. Again it moves down. Touches the oversold area. Take your sell. Now this time the RSI moves to the overbought area 70. It touches the 70. This tells you that the trend is no more stronger on the downside. There is something which has changed here. The momentum has changed. The price has changed. It has moved into a bullish territory. Yes, long and short trades both can be taken like this. In the previous slides, I have explained how to take long trades, Sandeep. So this is the way, right? Trading can't be so simple. What you have been thinking. Is it so simple? Just RSI. Can you trade with the RSI? RSI cannot be a standalone indicator to trade. These are the myths that are flowing in the air, flowing on the Facebook, flowing on the Twitter. Use it differently. Right guidance, right mentoring. That is what is important to survive in the markets. So, as I have told you, that pullback will halt at neutral zones. So 50 is a neutral point, and a zone above it and below it are the neutral zones. So see how the pullback halts at 50. In the uptrend, the pullback is halting near the zone. This is an observation. So this was the setup that we have practiced. The rise to take the oscillator reading into the overbought zone is a sign of strength of the trend. So when you are moving into an overbought zone, that means when you are moving into a downtrend and the rise takes the oscillator into the 70 area, that means that is the sign of weakening of the downtrend. And a new push to the overbought zone is a sign of strength, and the next dip is to be bought and sold. So copy this. Anyways, this first class will be put on YouTube uh, in some time, and you can view it again. Right? So this is the end of the first session, and if there is any question, you can shoot in the chat box. Still there are many people who have joined me for this session for the whole course, and still there are people who have who wanted to just take a sip of what the RSI cup is all about. So hope I have stood up to what they wanted to know about RSI and how we can trade with the RSI. Thank you, Sandeep. There's a lot to learn. Here we have 131 slides, and we have more than 9 to 10 setups. There's a lot to learn. The international price of this course is more than $3,500. So